All right, today we are going deep on what is, for many taxpayers, a total nightmare scenario. We're talking about getting a massive bill from the IRS for income you never, ever saw. We are going to break down exactly how to fight back when a bogus Form 1099-K, usually from identity theft, puts you right in the crosshairs of the IRS's automated collection machine. So picture this. You get home, check the mail, and there it is. That official-looking IRS envelope. Your heart kind of sinks, right? You open it up and it's a CP2000 notice. It says you owe thousands, maybe tens of thousands in taxes on income from some company you've never even heard of. It feels completely impossible. But here's the thing, it's not. So what do you do? How in the world do you fight a machine when you're the one who's been wronged? Let me tell you, just scribbling "this isn't mine" on the form and mailing it back is going to do absolutely nothing. The key? The only way to win is to understand the system you're up against and then use a very precise procedural defense to take its automated claims apart piece by piece.
Okay, so here's our game plan. This is the roadmap for how we're going to tackle this. First, we need to understand the automated threat itself, the CP2000. Then, we'll deconstruct the form that started all the trouble, the 1099-K. After that, we'll build our legal counterargument, get into the critical identity theft affidavit, and finally, pull it all together into a bulletproof response strategy. First things first, we have to get our heads around the machine we're actually dealing with. That notice you're holding, it wasn't sent by a human being. There wasn't some IRS agent carefully reviewing your file. Nope, it was automatically spit out by the IRS's incredibly powerful Automated Underreporter program, better known as AUR. So what is this AUR program? Well, think of it as a giant, relentless matching game. And this is all laid out in the Internal Revenue Manual, Section 4.19.3. The system just vacuums up billions of third-party information returns, W-2s, 1099s, all that stuff. And it compares them line by line to what you reported on your tax return. If it finds one single thing that doesn't match, bam, it automatically flags your account and generates a notice. No questions asked. And this part is absolutely critical to understand. The CP2000 isn't just a random letter. It's a specific step in a very dangerous process. It might start with a softer notice, a CP2501, which is just asking for info. But the CP2000 is the real deal. That's the formal proposal for more tax. The real danger, though, is ignoring it, because that's what leads to the final boss, the CP3219A, the Statutory Notice of Deficiency. That notice is your ticket to tax court, and it starts a 90-day countdown that is non-negotiable. You miss that deadline, you've lost your right to argue your case before you have to pay. Okay, so what is this piece of data that's triggering this automated nightmare so often these days? More often than not, it's the Form 1099-K, and if we're going to fight it, we have to know it inside and out. And that starts with the specific law that brought this form into existence. The whole legal basis for this form comes from one place, Internal Revenue Code Section 6050W. You really need to know this code section. It basically mandates that companies that process payments for other people, the law calls them payment settlement entities, they have to report those transactions directly to the IRS. It was created to close a massive gap in income reporting. Now, here's where it gets a little technical, but I promise you, this distinction is absolutely crucial. The law, Section 6050W, splits these payment companies into two different camps. On one side, you have your merchant acquiring entities. Think of your traditional bank processing a Visa or MasterCard transaction. On the other side, you have third-party settlement organizations, or TPSOs. This is the modern world, PayPal, Stripe, Square, you name it. And the rules for when they have to report are totally different. Now, I'm sure you've all heard the magic numbers that get thrown around all the time, right? Over $20,000 in payments and over 200 transactions. But here is the trap. This is the detail that almost everyone gets wrong. That $20,000 200 transaction threshold, it only applies to the TPSOs, the PayPals and Stripes of the world. It does not apply to the old-school merchant acquiring entities. A bank can issue a 1099-K for a single $1 transaction. Let me repeat that, $1. This is a massive misunderstanding that causes so many people to wrongly ignore these forms, thinking they're safe. They're not. Okay, so we know the system we're fighting, and we know its weapon of choice, the 1099-K. Now let's talk about how we build our defense. We're going to use this knowledge to build a legal counterargument that actually forces that automated system to grind to a halt by shifting the entire burden of proof. See, in any tax dispute, there's this heavy legal concept called the presumption of correctness. It basically means the IRS is assumed to be right, and it's your job to prove they're wrong. It's a huge uphill battle. But, and this is a really big but, that presumption gets incredibly fragile when the IRS's entire case is built on a single piece of unverified third-party data like a 1099-K. And this brings us to your shield, your secret weapon. It's Internal Revenue Code Section 621D. You should write that down, memorize it. This little section of the tax code is your silver bullet. It was designed for exactly this kind of situation, and it gives you, the taxpayer, a legal tool to flip the script and put the burden of proof right back on the IRS. So how does it work? Well, the code is very specific. It lays out a clear two-step process. Step 1, you have to assert a reasonable dispute. Claiming this is the result of identity theft is the definition of a reasonable dispute. Step 2, you must fully cooperate. That means you give the IRS all the reasonable help they need. Affidavits, police reports, whatever you have. If you do those two things, the game completely changes. The IRS can no longer just point to the 1099-K. They now have to produce their own independent evidence that actually connects you to that income. So, if identity theft is at the heart of this whole problem, then your entire case, everything, is going to hinge on one single critical document, the identity theft affidavit. And following the IRS procedure for this form is the procedural keystone to your entire case. Now, it's important to know the IRS sees a difference between general identity theft, like a stolen credit card, and tax-related identity theft. This is our world. This problem is so widespread that the IRS has a specialized unit that handles only these cases. They even put a special marker on your tax account transcript. You'd see it as Transaction Code 971, Action Code 522. That's the internal flag that tells everyone an ID theft claim is in process. Okay, everyone, listen up, because this right here is the single biggest, most disastrous mistake people make. It all comes down to one little checkbox on one form. Form 14039, the Identity Theft Affidavit. If you check box 1 on the left for proactively reporting ID theft, your form gets sent into a black hole, a general processing center. It will almost certainly never get linked to your active CP2000 case, and that automated system will just keep chugging along. You must check box 2 on the right, the one for responding to an IRS notice. And then you have to mail or fax that form to the specific address listed on your CP2000 notice. It is the only way to connect your claim to your case and stop the machine. All right, let's bring it all home. We've got all the individual pieces of the puzzle. Now it's time to assemble them into the complete, comprehensive response package that will force the IRS to acknowledge your claim and officially shift that burden of proof. Look, your response has to be methodical. It's not just a letter, it's a 4-part tactical package. Here's your checklist. Number 1, the CP2000 response form itself. Make sure you check the I do not agree box. 2, your perfectly completed Form 14039 with that all-important box 2 checked. 3, a cover letter. This is where you play your trump card. You explicitly cite Internal Revenue Code Section 6201D and put them on notice that the burden of proof is now on them. And finally, number 4, your supporting evidence. And speaking of that evidence, there is one piece that is the absolute silver bullet. It's what we call a bank record denial. You need to contact the company that issued the 1099-K, PayPal, Stripe, whoever, and get them to provide you with a letter on their letterhead confirming the account doesn't belong to you. This is incredibly powerful because you are directly refuting the 1099-K with information from the very entity that created it. It makes your case almost impossible for the IRS to deny. When you take a step back, this whole process really forces us to ask a big question in our automated world. When a computer can accuse you of owing tax based on one single piece of flawed data, who really has the burden of proof? Well, the system is designed to place it squarely on you. But as we've walked through, if you understand the rules and you use the tax code against itself, you can shift that burden back where it belongs, forcing the system to prove its case instead of just assuming it's right.